So, one of the things that you may want to do with one of your clients as part of your discussions is look at a loan or bank facility. And the way to do that, we're going to go through today. Um, so, the first thing that you do, as always, when we're looking to create a budget or a forecast, is we hover over the entity that we're interested in creating that budget or forecast for. We click on the forecasts icon, gives us all of our old forecasts and so forth. And in this situation, I'm just going to create a rapid forecast, generates 12-month forecasts based on the last 12 months of actuals. And so we're just going to click on that. Now, this is quite a complicated organization, so it's probably more reflective of some of the clients that you may have. Don't be intimidated by the number of accounts. What we want to do is we want to simply move to our non-current liabilities in this case because we're looking at a new loan. This could either be for an existing loan like this entity has, or it could be a totally new account if we're thinking about a new asset that the client would like to purchase, or a new bank lending facility. Then we may be thinking about something totally new. So let's make one of those. So in this case, the organization or our client is looking at a $100,000 term facility. It's got a very simple repayment profile of $1,000 per month. And obviously, we want to reflect this in our cash flow statement. So, the first thing that we do uh, is that we go to our new mock account that we created by clicking that circular plus button. And the first default uh, location within this mock account settings that you'll be presented with is the configuration that's highlighted in blue. I'm going to give it a name, and we're just going to call this loan, term loan. You may want to give it more, but this is pretty simple for demonstration purposes. Now, the thing that you want to do in here is that you want to include this balance sheet account line as a financing cash flow. So where it says include in financing cash flow calculation, we click on the yes, and it'll go green. You'll see that over in the left-hand side, it auto-saved. So everything that you're doing in the configuration automatically updates and auto-saves. So you don't need to save this configuration. And now we can just for a sense check, let's go to the cash flow section of the forecast. And you'll see we've got a term loan in here, but of course it's empty because we haven't included any data for that term loan. So let's let's go back to the assumptions. Let's go back to our non-current liabilities. Open up the term loan, and we've got a rapid input here. And this is quite a simplistic example, but given this is a 12-month forecast, what we want to do is we want to say set all months of this balance sheet item to 100,000 for this $100,000 bank facility that our client has. Now we're going to save that. And keep in mind, when it comes to all your assumptions and inputs, we always want to save them. Everything else happens automatically, but because here we might be applying a few rules, it's necessary to hit the save button. Now we can close this. And if we come into our cash flow section, you'll now see, much like earlier, we had the term loan, but now we've got a cash inflow of 100,000. And so that's great. We've got $100,000. Our bank balance has then increased by that $100,000 amount. And we can go and have a look at our bank balance. It's our 80,000. If we have a look at our non-current liabilities, and if we toggle that off, we're actually in a little bit of trouble earlier. Our bank balance was, we were actually in the red, almost $20,000 in this for this organization for that month. So you can see this entity probably needs some kind of bank facility. Let's toggle it back on. Now, obviously, we're not done here because, as I mentioned earlier, this bank facility needs to be repaid at an amount of about $1,000 $1,000 a month. Very simple assumption, but let's just make it simple for the demonstration purposes. And what we need to do is we need to contract this balance sheet item by a set amount. You can also do it on a percentage basis, but we're going to use a dollar amount. And we're going to say that we want to repay from the first selected month. Notice that we're not selecting the first month. That's the cash inflow month. We'll assume there's no repayment in that first month. There may be, whatever it is with your client. And now we want to apply this, and you'll see that, okay, this loan is being repaid. We had $100,000 inflow in the first period in February 2022, and thereafter we've got a $1,000 repayment on that loan in each period. Once again, we click save, or in this case, save and close, and you'll now see that we've got these little blue icons down the bottom, and it's showing what that outstanding liability is for each month of the term loan right until the end of the forecast. Now we can go back to the cash flow tab and expand the financing cash flow item. And now you can see this reflects the balance sheet cash flow term loan implications. So you've got a $100,000 inflow in February, and then in March onwards, you're repaying $1,000 towards that loan. Now, in the operating expenses, you can obviously then adjust the interest component or create a new line. Let's create a new line. We just call this one, once again, renaming it in configuration. And we can say term loan interest. Save that. And interest is not subject to GST. And we do want to include it in the income tax calculation, though, but we don't want it to be subject to superannuation, and we don't want it to be excluded from the cash flow because this is cash out, and of course the payment terms are going to be immediate. Interest line within the operating expenses within our P&L. We can go back to the settings for that account. And let's just make a very simple assumption that we've got $500 in interest each month. Obviously, your scenarios are going to be more complicated, but this is just to demonstrate. Now we've got $500 in interest owing on the loan each month, and we can go into our cash flow payments, and we can see it right here. And we can see, okay, we've got a cash outflow of $500 in each month, which is the interest on that term loan that we've created. Obviously, this is not subject to GST because we stipulated that it's not subject to GST, and it's also not subject to PAYG, super, and so forth. So that is a general overview on how to create a loan or bank lending facility. The same rules apply for, obviously, depending on the type of facility, but whether it's in the current liabilities or in the non-current liabilities, that's how you do it. Thank you for watching.